Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, 13th of August. US CPI came in mixed yesterday, but markets read it dovishly. September rate cut bets ramped up with the US Treasury Secretary, Mr. Bessent, even floating a 50 basis point move next month. So equities rallied and the US dollar softened, and a weaker greenback is a gift for emerging markets and could even help oil sell off lose steam. So we'll get into all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So yesterday's US inflation data was mixed, but the market reaction was not. So core inflation in the US printed the strongest gain since January this year, and the yearly figure accelerated more than expected to 3.1% in July. But headline inflation came in slower than expected, steady at 2.7% and not at 2.8% as penciled in by analysts. Normally, core inflation is the one that the Fed looks at for deciding what to do next with its monetary policy, so we could have well seen the market react to yesterday's CPI data by scaling back expectations of a Fed rate cut for September. But no, investors rather propped up the September rate cut expectations yesterday after the CPI release on thinking that the imported goods inflation in the US remained less than feared by many as companies broadly continue to shoulder the tariff costs. As such, the US 2-year yield fell posterior to the data release yesterday. The probability of a September rate cut soared to 94% from 80% prior to the data, and the US dollar slipped back below its 50-day moving average. The index had already reversed its summer positive trend last week, remember, so game is on for further weakness in the US dollar. There is still one more set of PCE, jobs and CPI data from the US before the next Fed decision, even though the new BLS chief is now willing apparently to pause the monthly releases of the jobs data to correct the data collection, but the chances are that the Fed will deliver a 25 basis point cut in September. But the story doesn't end here. US Treasury Secretary Mr. Scott Bessent now calls for a jumbo rate cut in September because he thinks that a 50 basis point cut would be great to cover up the US jobs weakness that is caused by Donald Trump's own trade policy. So we are watching a yield curve steepening story unfold in the US on rising rate cut expectations from the Fed that actually push the short end of the yield curve lower, while the exploding US debt levels prevents the long term of the US yield curve from softening by a similar size. So that's giving way to a steepening of the curve. Now, one hope is that Donald Trump's money collection from tariffs and directly from companies like Nvidia and AMD on their overseas operations could actually fill in the government's coffers, and that would diminish the need for longer term treasury issuance and help controlling the long end of the yield curve. So investors remain motivated right now by the upcoming rate cut from the Federal Reserve that could eventually support growth rather than debt worries that, however, are still big as a mountain on the horizon. And despite all, the S&P 500 actually advanced to a fresh all-time high level yesterday after the US CPI data release. Mid-cap stocks rallied more than 2%, while small caps rallied 3%. And bullish sentiment for equities reigns on the back of the softening US dollar, robust earnings, rate cut expectations, and of course the technology appetite. Speaking of the US dollar now, the greenback softness actually continues to give support to major currencies in the sense the euro dollar is extended its gains above its own 50-day moving average after the CPI data, while cable is testing solid resistance near the 1.35 mark that also matches its own 50-day moving average and will more likely than not to give in to the sterling bulls as yesterday's jobs data from the United Kingdom has been significantly better than expected by analysts. And combined with rising inflation pressures in the UK, fueled the expectations that the Bank of England will probably hold off from cutting the interest rate in its November meeting. So that combination of more dovish Federal Reserve and more hawkish Bank of England outlook should give support to cable and bring the 1.38 level back on the table for the coming weeks and months. Elsewhere in the FX and central banks, the Aussie dollar is stronger even after the Reserve Bank of Australia's decision to cut its rates yesterday and leave the door open for more interest rate cuts. So the US dollar's global weakness continues to drive the FX markets altogether and also has implications beyond the FX space, because note that softer US dollar makes EM investments look great again, as emerging markets' borrowing costs become cheaper with a cheaper US dollar, and their import costs of raw materials, for example, decrease because raw materials like oil and metals are denominated in US dollars in the international markets. And cherry on top, their ability to control inflation levels leads to supportive monetary policies due to weaker US dollar, hence stronger local currencies. In this context, Brazil's central bank, for instance, has taken advantage of a stronger real and cheaper imports to cut its Selic rate from 11.75 at the start of this year to around 10% by August without even reigniting inflation. And similar trends are also visible in Chile, for example, and Indonesia, where currency stability due to softer dollar has given policymakers their room to ease their rates and stimulate growth. And so it's no surprise that the MSCI EM index has outperformed the S&P 500 this year, riding the tailwinds of easier monetary conditions and a softer greenback that somehow and magically counterweighted the negative impacts of US trade policies and all the uncertainties due to the disrupted global trade environment. In the same context, while softer US dollar should also help throw a floor under the oil sell-off, as softer US dollar makes oil more affordable for most economies out there. Now note that OPEC, for example, increases global growth forecast by 100,000 barrels per day this week to 1.4 million barrels per day, suggesting a tighter global oil market than they previously projected. They also expect oil supply outside the cartel to diminish by the same amount, perhaps due to lower oil prices. So that should normally keep oil prices supported. While I'm not fully convinced by OPEC projections, as they clearly have interest in making these numbers match their interests, and the US Department of Energy just lifted its own forecast for this year's global oil surplus to 1.7 million barrels per day. In contrast, well, I still believe that the barrel of US crude should now not be able to ease sustainably below the $60 per barrel level if of course the US dollar continues to weaken globally. So that's, mind you, a positive adjustment compared with my earlier expectation, my earlier projection of a potential fall in US crude toward the $50 per barrel this year. In the short run, US crude fell yesterday in reaction to a surprise 1.5 million barrel build in US inventories last week. So that means lower demand from the US, but geopolitical risk right now remain tilted to the upside, as the upcoming meeting between the US President Donald Trump and Russian President Mr. Putin hardly points at any material progress for ending the war in Ukraine. Someone even said something that I really liked. He said that US-Russia talks are as if you were just trying to sell your neighbor's house without your neighbor being in the selling conversation. So it will probably lead to little and probably no progress in the short run, which could then lead to a rebound in oil prices to and above the $65 per barrel level in the short run. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.